Welcome to Chapter 4 of Mercury Investors Trading Program. In this chapter, Abdul is going to be explaining the different types of time frames that you can trade. Now, again, it doesn't mean one time frame is better than the other, but I'll go ahead and let Abdul explain that to you guys, what the difference is, and which one suits you. Enjoy.
So in this video, we'll go over the importance of multi-time frame analysis, how to do it, what to look for in each time frame, and how each time frame can affect a trader. Let's get straight to it. So why should you use multi-time frame analysis? Using multi-time frame analysis shows you a clearer picture of what's happening. There are things a 4-hour chart will show you that a 15-minute chart won't. And there are things that a 15-minute chart will show you that a 4-hour chart won't. So what time frame should you use? Well, the answer to that question is purely dependent on the type of trader that you are. There are 4 main types of traders: scalpers, day traders, swing traders, and position traders. The type of trader that you are will directly determine what time frames you should be using for your trades. So scalpers look to profit off moves that have already happened in the market. They trade heavily with momentum, and they only hold their positions for a few seconds to even a few minutes. They tend to be in and out of the market quickly and don't make many pips, but of course, once you take into account proper risk management, they'll still make a decent amount of money. For scalpers, they'd usually use 5-minute chart, 15-minute charts, 30-minute charts, and the occasional hour charts, just to show the bigger picture. So day traders are typically people who will place a number of trades in a single day. They'll hold their positions for minutes to even hours and even occasionally a few days. They'll trade a number of different styles, including scalping. They usually use 15-minute, 30-minute, 1 hour, 4 hours, and occasionally the 1-day charts so they can get the bigger picture. They tend to make more pips than scalpers, but less than swing traders. So they'd look to make over 20 pips per trade, but rarely ever make more than 50 or 60. Swing traders, they're people who would place maybe 3 to 8 different trades per week. They'll hold their positions for at least a few hours to even weeks or months occasionally. They try and enter a trade at the start of a reversal and just hold it until a point where they can't see price going any further, and often they can actually hedge. Hedging is effectively having one trade open, for example, a buy. They hold that for a while, maybe it's in 200-300 pips profit. They take some profit out of the market but leave a little bit of the trade running, and then they put a sell on at the top. They look to make a bit of profit off the sell, and whichever way the market goes, they'll profit. So swing traders look to make at least 50 pips per trade, but a good trader is capable of making over 1,000 pips on the occasional trades. They tend to wait for trades to come to them instead of looking for trades, which means there are occasionally weeks where they don't place any trades. Position traders, they place few trades on a monthly to yearly basis. They'll hold positions for weeks to years. I've heard of position traders holding positions for over 7 years at times. They'll use daily, weekly, and monthly time frames and 4-hour for better entries. They look to make over 1,000 pips on each trade, and that's why they hold them for so long. They're probably the most patient traders you can find, because they wait for trades to come to them. Usually they trade with a large amount of capital because their stop losses would be huge, so they wouldn't make much profit if they didn't have too much money. So what does that mean for us? Well, my preferred style, and the preferred style of this whole course, would be day trading and swing trading, because they are heavily based around analysis, and they give you the best risk to reward ratios more often than not. Also, they allow you to be more versatile in where and when you take your profit and how you actually manage your trade. So swing trading, how do you use your time frames? Well, Swing trading and day trading require a trader to be aware of the bigger picture. And to get the bigger picture, you have to use the higher time frames. So these are your 4 hour, 1 day, 1 week, 1 month time frames. The higher time frame trends and support and resistance, as well as their candle formations and chart formations, tend to cause bigger moves and hold a lot more consistently than on lower time frames. For example, a head and shoulders pattern on a 15-minute chart will cause maybe 30 pips to the neckline, whereas head and shoulders on a 4 hour chart can cause over 100 pips just to the neckline. So here's an example. So you have your neckline here highlighted by the red. You have your left shoulder. This is a 4 hour chart as well. You have your left shoulder, your head, your right shoulder. And from the right shoulder to the neckline, 101.5 pips, which is a really nice trade for most people. With a closer look at that, you have left head, and you see actually that your stop loss and take profit, once they're put together, you have a bigger risk to reward ratio, which is 5.71, which means if you risk 1% of your capital, you make 5.71. If you risk 2% of your capital, you make 11.4%. Okay, so let's take a look at a 15-minute chart. So there's your left shoulder, your head, and your right shoulder. And look, 29.2 pips. This is on a 15-minute chart, inverse head and shoulders pattern. So let's take a closer look. So with this, you have your stop loss and take profit put into there, and you'll see that the risk to reward ratio is 3.18, whereas on the 4 hours it was 5.71. So this means you'll make a lot more trade in 4 hours than you would trade in 15 minutes. As I state here, 5.71 to 3.18. So you can make more profit and more pips just using the bigger time frames. So how do you utilize these? Well, in terms of a swing trader, your main analysis should be done on 1 day charts and 4 hour charts. Your 1 hour charts are used to look for price action to confirm that your bias is correct and your analysis is correct, and also just to refine your trend lines to make sure they're drawn precisely, because if you miss out on a few millimeters, it could be a trade that you potentially missed out on, which could have made you quite a bit of profit. Your 30-minute and 15-minute candles are used to look for your entry, as the better your entry, the better your risk reward ratio. Rejection candles also show up better on shorter time frames. For example, here is a 30-minute chart and here is a 4 hour chart. These are the exact same chart, Great British Pound US dollar, Great British Pound US dollar, and this is just the top of the right shoulder. So this is just this area here. So it all looks nice here, all looks clean. But if you take a closer look, you'll see here, you've got one big rejection wick here, you've got a shooting star here, you've got another shooting star here, you've got an evening star formation here, you have a pullback for a potential entry, you've got big wicks rejecting at this level again, and you have a bearish engulfing leading into an evening star formation, and then once again another pullback opportunity to enter. And all of that has just come from that, which is why it's important to use your lower time frames to get your entry on your trades. So to conclude, in chapter 5, we'll just be going over indicators, the best ones, how to use them, and what not to do with indicators, because there are a lot of situations where people will trade based off indicators and they find out that they are heavily wrong, and they've already lost a lot of money and time trading off those. We appreciate you for watching, and we hope to see you in chapter 5. Thank you.